because every time someone decides, even if it's 50 grand or 100 grand or $500,000 or $1 million, it's still predicated on, does that person trust that you can do it?
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have Lance Pederson. Lance, how are you doing today?
Doing good, man. How are you doing?
I'm doing fantastic. A little bit about Lance. He's worked in the middle real estate space for more than 13 years, helped over 180 entrepreneurs, architect pool investment funds. He's passionate about the power of transparency, which we'll dive a lot into, in building trust between sponsors and investors. He's the founder and managing partner of verifest, which we'll dive a lot into. I want to talk a lot about what verifest is and does. And principal of Fairway America, private equity real estate company in Portland, and the host of a podcast, Real Estate Risk Report, featuring conversations with real estate sponsors around the topic of risk mitigation. So with that said, Lance, why don't you give our listeners a bit more about your background, and then we'll dive into what you're focused on today.
Sure. Yeah. So, I got into the real estate business in 2008. I was a member of Entrepreneurs Organization for years, and I had met the guy in my forum group, fellow entrepreneur who was a commercial hard money lender. So I sort of teamed up with him in 2008, focused more on the back office side of things. He was more on the underwriting and, servicing side and the asset management side. And so that's sort of where I came into the business from, was, loan to value and, doing loans and, borrowing money to commercial real estate owners, operators. And at that point, Matt, my partner, had been operating pooled investment funds since 2001. Is kind of a more efficient way to fund the loans as they came through, right? Was raise money from investors and then give them, exposure to the whole portfolio of loans versus, finding investors for each deal.
Yep.
So, really that's where we got, pretty deep in the fund management side and the fund architecture side. And then 2012, we pivoted the business from, just being a lender and really into more of, I'll call a private equity real estate firm, more of an allocator of capital. And we realized, one, there's a lot more upside on the equity side of the equation. And two, you just saw sort of an unmet need in the market, right? For, more sophisticated investors who understood some of these, sub-institutional real estate investment strategies. These deals are too small for the institutional investors to come down into. And at that time, the Jobs Act was sort of just sort of something on the docket. And we saw that coming as well. And that, of course, sort of took hold in September of 2013. So really, that's where we sort of jumped in and got into the game and started advising real estate guys around the country who were looking to, turn up and launch a pooled fund, whether they were, buying multifamily properties or, once again, doing loans, hard money loans, fix and flip loans, those sorts of things. And we created a diversified fund ourselves that our investors could, allocate capital into, that would give them, broad exposure to these various people we worked with, whether they were lending funds or, once again, multifamily deals or retail deals. And the accidental business sort of formed out of that was what is now referred to as verifest. So we learned quickly that this back office thing is a big issue and a bit of a, the reporting left much to be desired, right? And so if the downstream, deal sponsors and real estate entrepreneurs couldn't get the reporting done, we couldn't do the reporting at our fund level. So we started offering it as a service to those we worked with, really more for our selfish needs, so that we could actually, get the reports on time. And that turned into a full-fledged business, sort of the accidental business, where we were doing all the accounting and bookkeeping and fund administration for people all around the country. So fast forward to 2021, we've got 2.2 billion plus in assets under administration, and clients all over the country that we're doing all the middle and back office administration for. So that's kind of where my roots came from, was just more of that back office, the accounting stuff, getting all that reporting sort of nailed down, and that's sort of my bent on things. And obviously we've got some other things we've done along the way that we've learned that I'm sure we'll talk about.
So let me just make sure I understand exactly where you were. So you were, and maybe still do, you were raising money through a fund, and you guys were taking that. Were you then allocating that money to different lead sponsors? Is that how it was going?
Yeah, exactly. So often what would happen, right, is someone would engage us to say, hey, we want to do a fund, to buy multifamily properties, but we're syndicating our deals one at a time with friends and family, and we kind of want to make that leap. So they'd end up paying us a fee to sort of help them architect and go from not having a fund to having a fund. And then what we would typically do is say, hey, we'll be your lead investor. We'll invest $1 million into your fund. In exchange, we want some percentage of the general partnership. Or whatever we could do, right? Because we solve their problem. They've got a lead investor who knows what they're doing. They've got, they can kind of get going. And now, out of our own fund, our investors have of course got, better economics. They got a GP position and those sorts of things. And we're the ones who did all the underwriting of the sponsor and their deals. So yeah, that's sort of how we got into it, was just realizing that, hey, people need money and they've got deals, and we know what we're doing, and we can underwrite them and vet them. And
yeah. And so you're sitting here, you'd partner with this lead sponsor who's supposed to be doing their job. Yeah. And you were finding out the reporting's not quite there, the communication's lacking. Yeah. And you're having to report to your investors. So if they're not reporting to you, you can't report properly to your investors. Ultimately, it looks bad upon you, because it comes back down to, well, Lance, why aren't you communicating with us? What's going on at this property? And you're going, well, I don't know. The guy in charge isn't communicating. Well, no, I invested because you
got it. It's our problem, right? Yeah. So we were pregnant with the problem, right? So we had to do something about it. You got it. And so that's what it was. We just realized that, hey, it's a lot of work, trying to find deals, you're underwriting deals, and then not to mention the asset management and the negotiation, and there's a lot of moving parts. And so of course the piece that sort of gets neglected or is often the least mature inside of a real estate investment firm is sort of those back office operations, right? Just the reporting function isn't very good. And it's usually because the people who started the firm were more pure play real estate guys. They're deal junkies. They're good at sort of negotiating and finding good deals, not so much really enamored with, accounting and all the other things that come along with it. Right. And so,
but when you're dealing with investors, they want to see that. And that's, to the investor, is transparency. It's, they like the fact that you're a deal junkie. They like the fact that you're getting them deals, but they're not you, and they don't see what's happening on a day-to-day basis. So you, as being the deal sponsor, you might go, well, this project's going really well. Like, I don't know why people are upset, because everything's going well. Well, yeah, but you're seeing it on a day-to-day basis, and their way of seeing it is through you. And if you're not communicating, you're not doing it right. Well, at least your investors think that.
That's exactly right. Yeah, that's exactly right. Yeah, that's exactly right.
Yeah, that makes sense. And I would say we do a decent job, but what I would have said before hearing from my investors, I would have said we do an okay job, but we need to step it up. Yeah. Now, hearing from my investors, we do an excellent job, and the market, the rest of everybody else, not everybody else, obviously, but a lot of other people are doing a bad job. And so when I'm saying we do okay, we need to step it up. That must mean that other people are doing a really bad job
Yeah.
at communicating with their investors. So verivest, I think, is an extremely valuable what you guys have created. So let's talk about the creation. Let's talk about, you've already kind of talked about why. So now let's talk about what have you guys created that helps people, that helps the sponsors, and then that helps the investor as well.
Sure. Yeah. So I think, as as investors ourselves, right, is sort of our start. We were on the other side of the table first and foremost. So, we just looked at it from, well, what did we feel like we had to do in order to complete and conduct, appropriate levels of due diligence upfront, and once again on an ongoing basis, what do we need, to feel comfortable? And so at verivest, what we've really done is taken that along with all the feedback from end user, sort of just, garden variety accredited investors, doctors, dentists, lawyers, like getting feedback from them,
Yeah.
as to what they wish they could do that they're not doing. And so it all starts at the sponsor. And so, we would always run background checks on people, which of course, when you're writing 7-figure checks, getting the sponsor to, let you run a background check on them is not that hard, right? Writing a $50,000 check, it's a little awkward. It's not to say the sponsor won't do it. So at verivest, what we do is we said, okay, sponsors, verivest will run the background checks on you, right? And we've got criteria, so we'll go back 7 years, and if you meet those criteria, then you can sort of be part of our network. So that's benefit to the investors, and now you don't have every investor asking. They can go right to your profile on our website and see, sure enough, here's the results of their background check. These guys are good guys. And then I think the other one was, sort of the track record. Most sponsors want to tell you how great their track record is. They've got a proven track record. From our standpoint as investors, always like trying to get the details of said proven track record was always very challenging. It continues to be challenging. And it's time and it's laborious, right? So even
that's why it's challenging, I think, because it's very laborious. If I think back and I'm trying to give you my track record, I can give you some, but like, man, if I got to write, I started at a totally different spot than where I'm at now. So like tracking some of the earlier data points, that's way more difficult because we didn't keep as good of books at the beginning. And so, yeah, I could see that being very hard to get that information and talk about time consuming. I got to dig all that up. Like really,
Yeah, that's right. And so, I looked at it like, it's a problem in as much as, you're talking with investors, and especially if it's a new relationship, that's what you're sort of up against as a deal sponsor, is that the sales cycle that is so long,
yeah.
right? It's like just met somebody and they won't write a check for 12 or 18 months. And the reason they don't is because of the uncertainty that surrounds these issues.
Yes.
And so, what we tell sponsors, like, listen, it is hard to dig up. You got to dig up what you can, right? And us as sort of an independent third party will verify as much of it as we can. And, and so on your public profile, once again, even if you say that we bought all these houses or deals, these duplexes or fourplexes and, 2008, but I don't have the records, it's fine. We'll add it to their track record. We just won't put a little check next to it that says verified. Right. And I think that that's sort of what we're educating end user investors on, is just to understand that, that is sort of just how it goes. Guys get started in the business. They're not the greatest record keepers. That sort of stuff, just gets lost in the shuffle. It doesn't mean they didn't do it. Of course, you're looking for a little bit more high fidelity, in the more recent years, right? Like you want to see that the things that they did. But either way, from the sponsor's perspective, it's just saying, listen, just grin and bear it once and then keep it up to date on an ongoing basis. And you basically have a living track record that's on the internet, that's publicly accessible, that people can see. So when you're out there talking to new people, you can say, well, you don't need to trust me, right? Just go to our profile and you can see that verivest had it verified. So I think it ends up, once again, saving a lot of time for the LPs or the passive investors, along with the sponsors. It's just, You're not having to wade through all these awkward conversations with these new relationships. You can just sort of get to the heart of it. Listen, I'm not a crook. I'm not a criminal. I've had what I can have verified. This is what we've done. We've done it successfully. Here's what we're doing today. Here's our new opportunity. Let's talk about that. Let's just spend more time talking about the merits of the deal itself, right? And our ability to execute, on that business plan, instead of you trying to like hunt and peck around and figure out whether or not we're good guys or not, or waiting a year before you decide to make an investment. And I think the last piece, that we do at verifest, of course, is just realizing that, well, we're offering these back office services. So we're doing the accounting and the books and the calculations and the waterfall calcs and sending out the statements and all those things, that there's an oversight component that comes along with that, right? We clearly want to make sure if we're doing that stuff that we're not sort of aiding and abetting someone who's running a Ponzi scheme. So as administrators, we're always making sure that the stuff that's being provided to us by our clients is legitimate, meaning, if I get a closing statement, I'm going to go look on the public record, search the database, make sure this is legitimate and it isn't sort of fabricated. I want to make sure these assets are legitimate. And we've always done that. And so it sort of dawned on me, once again, like that's the stuff we can do. Not everyone needs to have some full-blown financial audit, but what we can do is follow the money. And if we follow the money and that ongoing monitoring, so once someone invests, if we can, once again, as independent third party, give greater peace of mind to the end user investor that someone independent is watching where all the money goes and is ensuring that those assets are properly titled and, are real and they actually exist. Mm-hmm. It just takes that off the table. Because what happens for a lot of investors is that they sort of wait the 12 months, 18 months, they decide to make the investment, they're getting their distributions as they said. But even when things are going well, they're a nervous wreck thinking that this might be some sort of Ponzi scheme. They're waiting for the other shoe to fall, right? Or the other shoe to drop. And so, and that is just over and over and over again, talking with investors, that's the feedback you get. And so I've just realized like, that's just way too much friction. And of course, this is all unspoken, right? Most of these things are never being said out loud when you're in this conversation with a potential new LP or investor. They're not saying, well, you know what I'm really thinking? I'm just not sure if you're really a good guy. You seem like a good guy. I'm not really sure if I can believe you or not. And I'm not really sure if you're going to rip me off or not. They're not saying that, but they're thinking it. And so for us, we just see that benefit on both sides of the aisle is just, let's just remove that friction and, and just make it easier to sort of make those connections. And then of course, from the sponsor standpoint, being able to take a lot of that administrative burden, off your plate, because I think for us, having done it ourselves, and for many of those we've talked to, building a full-blown back office is expensive. It's costly, it takes time, and you've got more head count to manage and all those things. And more often than not, once again, real estate guys aren't like the world's greatest people managers. All things being equal, they'd much rather not have more people to manage, let alone them be accountants who are, I love them. We got a ton of them, but they're a different breed. They're certainly not, real estate people. So that's sort of the, our benefit is you plug into the real estate ecosystem. I think we just help remove a lot of that friction that exists, especially on the capital management side.
Yeah, no, that makes a lot of sense. And you're giving good, clear reports. Like the back end, I think is huge to have that. Most investors don't have that. Or if they do, it's either not done right. It's not done well. It's not done timely, or it's just a big distraction out of their business.
Yeah.
You'd be probably better served because a lot of people try to hack it and do it themselves, right? That's just the entrepreneurship spirit. Like we can do it all on our own. So one of your partners is doing all that. Maybe it's yourself is doing all that, where you'd be better served looking for deals, talking to new investors, managing your current deals. But instead you're sitting here trying to work on the back office stuff, and you're not doing it well, because that's not what you should be focusing on in the first place.
Yeah, that's right. And that's what we see when we work with our clients is that, because they're not accountants and they think, I think we're pretty good at it, and then us as sort of professionals, we look at it and go, well, nice try. But it's, that's a bit of the issue, right? It's like, you don't know what you don't know. And it's the same problem. It's the same problem too when you're hiring people, right? When you're hiring people for jobs that you don't really understand fully yourself, right? Like, how do you know if the person you're hiring is any good or not? You know, it's difficult. And so, you know, I think for us, and it's just sort of, my background's always been sort of this outsourcing these sorts of, you know, support functions. So of course I'm just a huge fan. And I just believe, like, if it's not a core competency and you're not going to like win the day based upon how great you are at it, then it should be outsourced as much of it as you can. And not to mention too, is just, and you know this, Todd, of just trying to scale a business like this, is that when you're really in the early going, it's just you, and you can sort of find deals and whatever. But when it really starts to scale, the headcount, even on the asset management and the acquisition side, it's just, you need more people than you've got revenue coming in the door. And so you really have to withstand, you know, that it's just hard to get through the dip in this business, because so much of the upside is back end loaded. And so until you really fill the pipeline with deals that are sort of ready to go full cycle, and you can, you know, get that promoter carry on the back end, it's just, a lot of people get stuck there. And I think for verifest, just at its core, that's sort of what we're trying to make it easier, where it's just easier to sort of get through that dip, because it's all, you know, these fixed expenses are really more variable expenses. So you can just kind of, you know, it's just one deal at a time. They're deal level expenses. A lot of that back office stuff is being handled by us, and you don't have to add a, you know, $60,000-$70,000 a year headcount, which, you know, it just is not fully utilized, you know, straight away.
Right.
So
yeah, it's funny. My wife is marketing. Her background's marketing, and she recently quit her job, and so she's doing some of my marketing and some of my investor relations stuff. And she was looking at a marketing piece for my coaching business. I do some coaching, multifamily coaching as well. And so she's looking at that, and she's like, I love you, but this is horrible. She's like, and that's like what you're talking about. Like, yeah, good try, right? Nice try, but no, this isn't it. We think we can do it ourselves. No. Like, I'm not a marketer. I can't create a good marketing piece, but, you know, I tried. It was horrible.
yeah, that's right. You know, and it's just, it's that sort of acknowledgement of, you know, so it's interesting work with the guys, because a lot of the stuff we just talked about, I think on the surface, a bit counterintuitive. Because for most, right, when you think about, on this, you know, if you pan out, when we think about what verifest is doing on the surface, a lot of guys just look at it like, I need to raise more money. Like, so can you help me just, you know, I need to raise $8 million for this next deal by, you know, a month from now. Can you raise that $8 million for me?
Yeah.
You know, and of course, for me, my answer is no. But what I can do is help you get on a path to where we can make it easier to raise the $8 million.
Yeah.
So of course, that's not what people want to hear. And because a lot of
everybody wants it right away. Nobody
right
wants to take time to get there. What, are you kidding me, Lance? I mean, why do you want to take time to get there?
That's right. This is an amazing deal. Don't you understand?
Yeah.
Dude, I get it. Like, I'm not saying your deal's not awesome. I'm sure it is. It's great. Right. But it's just,
are you awesome?
Are you awesome? And it's just, and are you prepared? Right. And I think that's the whole thing. It's just that, are you ready? Are you at a place where you are ready to raise $8 million when you need to? And I think that it is a bit linear in this business, you know, as you go. And that's always say, it comes down to right now, how many people, you know, are in your investor database, and of those, how many of them are accredited, and how much net worth do they have? And so if in this business, if you want to make more money, you need to ultimately do more deals, bigger deals, right? I mean, that's just how it goes. So if you're committed to doing that and you want to grow and scale the firm and you want to make more money, it's going to require more capital. And to get more capital, it's going to require more names in your database, right? More connections. And I think that the thing that I think a lot of people overlook, or that there's this myth they buy into, is that they're going to find sort of this knight in shining armor, or someone's going to come along, it's going to be the single source investor who's just going to take care of that for them. And I think that, you know, the institutional investor, and I just spend a lot of time trying to explain to them that the more, if that did exist, you have to understand that the person that's playing that role is going to say, without me, you can't do what you need to do. And therefore, I need a disproportionate amount of the upside for playing that role. Right. And that's what institutional investors more often, that's what they represent. They want more control than you probably want to give. And they're going to charge you more. They're going to let you take less than you want to take. And so it's not a shortcut. Right. And I've spoken with lots of guys who basically, bought into that and took that capital and were miserable and felt like they basically owned a job for years and years and years.
Yeah.
And then they realized, like, this whole raising money from high net worth people now starting to make a hell of a lot more sense. But of course, since they were never developing the relationships, they may have done a bunch of deals and they got a pretty extensive track record, but they have no relationships to show for it. Right. So once again, because every time someone decides, even if it's 50 grand or 100 grand or $500,000 or $1 million, it's still predicated on, does that person trust that you can do it? And building trust does not happen overnight.
Yep.
Right. And so for me, I know people get this frustrated that I just get really focused in on this trust thing, but I'm like, it is the transaction. It's the transaction. How quickly can you get people to trust you? And if we can reduce the time it takes for them to trust you, then you're better off. And the more people you can get to trust you, and you can do it more at scale, that's what you're after. And in the age of the internet, this is the future, right? Like, so now you can build relationships with anybody anywhere.
Yep.
Right. And because with COVID and things like that, I mean, it's like now we've got additional barriers between us and relationship building. And so, before, and we learned this the hard way, Todd, because we spent thousands and thousands and thousands of dollars and days and days and days and days traveling around the country and the world, going places where we thought there'd be investors, and we ended up with nothing or little to nothing. I think that's when we realized, like, there's got to be a better way. And of course, the answer is the internet. There's people out there that'll wake up this morning that are looking for something in particular, a deal sponsor that's doing multifamily in the Midwest, in Minnesota, in Wisconsin, in Illinois, whatever that is they're looking for. And how are they going to find you? Right? Like, that's the issue, is that in this, the beauty of real estate is that it's fragmented. I mean, fragmentation is a feature.
Yep.
Right. And that's the beauty of it. And there's only so much of it. Yep. But it also means that that fragmentation is just super inefficient. It's hard to connect people that have the money with the people who've got the deals. And that's, so for us, that's really that breaking it down step by step and looking at it from that perspective is sort of, how we view it.
Yeah, that's a whole conversation itself, the fragmentation of the industry and how it's an advantage. And quite frankly, we could talk about where it's going right now. And I mean, that's a whole conversation itself. That's really interesting that you bring that up. But yeah, no, I agree. And I get I see a lot of, I'm in bigger pockets sometimes. And I see these posts like, oh, how do you find a sponsor that you can trust? So people don't know. They're looking for the sponsor that they trust. They're looking for that person that they can put the money with, the company they could put their money with, but they're kind of at a loss, because where do you find it? There's no publicly, well, there are, right? They're REITs, but there's no publicly traded private real estate syndication. I mean, it's just not there, right? So we can't just go really and just look it up. You type in multifamily syndicators and you're not going to get, like, that search is not going to give you the results you're looking for. So yeah, it's really challenging. How do you find it? And that's why I really like what you're doing with verifest, is I like that there's a place where people can go. And you and I had a phone conversation about all these sponsors out there, and many of them are good, and the vast majority are good. But then you've got some, and I don't want to say bad players, because they're not necessarily bad people, right? They're just not doing things maybe the right way. And they're being, sloppy in how they're doing things. And a lot of times I think the people that are doing things wrong are just young, energetic, and excited, and they're deal junkies.
Yeah.
But that doesn't mean they're good people to be investing with. And again, not saying their character is bad.
Yeah.
How they're conducting business is not necessarily the right way. And of course, there are some bad characters, right?
Yeah.
And that those people we for sure want to avoid like the plague. But you're trying to verify not only and weed out not only the truly bad people, but you're also trying to weed out the people that are deal junkies, but not really conducting business the way that somebody with private capital should be investing with.
Yeah, you got it. And I think that's where I call it. It's public accountability, because right now there is no public accountability. So you can be the enthusiastic deal junkie with a little bit of marketing chops who doesn't really know. It's just naivete. But there's nothing that's sort of checking you, right? And in the back of their minds, whether it's subconscious or conscious, they know that I've got 30 LPs in this deal. If the deal goes up in flames, I've just burned 30 relationships. And they use, once again, they go, there's millions of others, right? I'll recover, right? I mean, once again, conscious or subconscious.
Yeah.
But that's sort of how it goes. And I know the feeling, right? Because before, so we went through the process and we had to affiliate with the broker dealer, and I had to take like the Series 7, the 63 and the 65. They're really hard. You got to study, for all these things that don't even really matter to our business. And then you pass, but then, in the process, you realize like how serious this stuff is. Like you're in the business of selling securities. And, it sort of dawns on you. You won't pass the test if it doesn't dawn on you. But the day after you pass the test and you're affiliated with the broker dealer, there's a difference. Like the way that you do everything is it's that accountability, right? Because it's like, if I do anything and make a misstep and I'm not careful, that's going to go up on my profile on FINRA broker check. And, my reputation is out there for the world to see. And that was one of the things that happened that made me realize that even for me, a guy who considered myself, like most do, a man of high integrity, right? And one who would say I'm accountable or whatever. It's that even I found there's a different level of sort of like, okay, this is a little bit more serious. And it was that public accountability, knowing that, hey, I got to be careful if I had a few beers before I jump in the car, because, I get a Dewey, I have to report that stuff to the broker dealer and it's going to go up on my profile or whatever. You know what I mean? Like that's not there. That's the beauty of it for many of us, is that we operate in the unregulated sort of space using exemptions from registration, but there's not public accountability. So for me, if you're the fast and loose deal junkie and you're a verifest verified gold member, you're going to think twice before you start doing that stuff, because those results will become more public, right? Like if you start to tank this project, we're not going to let you sort of just stick your head in the sand and just burn 30 LPs. We're going to be like, you're removed. You're no longer verifest verified. And the world now knows that there's a problem. And it's that early warning sort of indicator. And I think a lot of it is just deterrence, right? I mean, that's what we do. Is the reason why we monitor and review the financials is just to keep people honest, because even Bernie Madoff didn't start out the firm by defrauding people on day one. It was only until he realized that he couldn't deliver the results he had promised that he decided that it was easier to cheat.
Yeah.
So, I know that's how it works. I've studied many, many, many Ponzi schemes to see what's at the heart of it. And 90% of them, it's probably not 90, it's probably, 70 or 80, they started out as honest people. And then they decided not to be one day, right? They decided to zig when they should have zagged. And so for us at Verivest, just holding people to a higher standard. And I know it's simple, like we talked about, but like we have members right now that are having trouble sort of reporting on a quarterly basis. And we're having these conversations like, you get the badge. I mean, you get to put the badge on your website that says you're Verivest Verified Gold, but that means that we're telling investors that you have the ability to report consistently and on time on a quarterly basis, and you're not able to do that. So you either fix it, have us help you fix it, or you're no longer affiliated with us. That's just how it goes.
Yeah.
Because that's simple stuff, man. That should be table stakes.
Yeah.
And that's what I mean. Investors jump right to the performance side, but I'm like, I wish we were at the point where it's just all about performance. But right now it's really about the basics, like communication and reporting and just the simple stuff. We have to solve those things first.
Well, and that's what it's always about, right? Isn't it? It's always about the basics and the reporting and the simple stuff, because that ultimately comes down to how you end up performing in the end. And you might perform well in a market like today, where everything is going up. But what happens when that market turns? It's the companies that haven't really been doing things the right way, but they've been able to get through it because of the market. The market takes a twist. Now what happens? Now Bernie Madoff comes out. Right. It comes out to play, and now we got problems.
You got it.
So, man, I want to talk real quick about the other company and your podcast. Tell me about Fairway America. What do you guys do?
Yeah. So at Fairway, that was really what, verifest launched out of. And so, we really split these companies apart, so now all Fairway does is it's an investment management company.
So you're still doing that investment side?
Yeah. So I personally, I'm just a shareholder at this point. I'm not involved in the day-to-day. So that's, I run all the stuff on the verifest side, the service provider side, and then my partners sort of handle all the investment stuff. So, we're, and it's been a great ride, building that up and, and really honing our own thesis as well. One of those things we always talk about is just, no matter what you do, you've got to have conviction about, you got to have a thesis, conviction over, what you do and why you do it. And, at Fairway, that's sort of what we've built is we've got, we partner with a handful of operators around the country that are executing sort of more niche-y type of strategies, like whether it's converting big box retail into self-storage or converting, extended stay hotels into multifamily or, those sorts of things is what we kind of go long on, identify opportunities that might, they may only have a certain sort of shelf life to them, but, from our position, we can kind of, do those things and then, launch something else that might be, that next thing.
Right.
Not for everybody, but so that's that side. And then the podcast really was just I decided to do it just because I was like, okay, we need to help investors become better investors, right? I need to be doing something along those lines. Yeah, is verifest offering a service that sort of removes some of that lift in the diligence process? Yes, but since we don't pass judgment on individual deals, I felt like we need to do something to help investors become better at that part of it. And so, it's a little counterintuitive too. Like a podcast about risk sounds pretty damn boring, but from my perspective, that's what I want investors to understand is it's all about assessing risk. So to think that there is little or no risk involved in these deals, you're just kidding yourself. If someone's going to pay you a double-digit return for putting money into something, there's a ton of risk. Once again, and it's figuring out how to assess how much risk exists and whether or not what you're being quoted is fair compensation for the risk you're taking, right? That's what makes a good investor. And so, and the only way to do that is to really get intimate with the types of risks that exist and the various ways in which people can mitigate those. And many of the things you and I just talked about, those are risk mitigants, right? verifest and the service that we provide is a risk mitigant. We help mitigate the risk of misappropriation of funds. We force them to report quarterly, which mitigates the risk of people sort of losing track of what they're doing and not paying attention. It's all those little things that you have to sort of take into account. And so that's what the podcast is all about. So it's not for everybody. We nerd out on all things risk, but I feel better at night when I go to bed knowing that at least I'm out there sort of trying to get the word out about, how to think about risk in a different way.
I like it. It sounds pretty cool to me. Probably a little nerdy too, but whatever. That's what I like. I like nerdy stuff. I just sent my podcast to somebody. I said, that's not really a real estate person. I said, here's some nerdy stuff that you may or may not be interested in. And I don't know, because this is what we love talking about this stuff, right? But not everybody. Some people are like, what are you talking about? I don't even know what you're talking about.
That's what most people say when they meet me. Like, I really have no idea what you're talking about. I'm like, I apologize. In fact, I had an investor the other day. He's like, I started listening to your podcast, and he's like, I've listened to, I don't know, a bunch of episodes, and he's like, I've now become really risk averse. Like now he's like to the point where he doesn't even want to allocate me capital. And I had to reply to him saying, okay, that was not my intention.
That's not the point.
Right? Like, I think you're missing the point now, good for you. I mean, that you're realizing, and I think that's what he was basically saying, was just that my eyes have been opened. I got into it for, the reward and wasn't paying close enough attention. And now he's realizing that there's a lot more there that you have to contemplate.
Yeah.
And, it's not my intention to get people to not allocate. It's just my intention to sort of make all the participants sort of be more thoughtful about what they do, why they do it, how they do it, and having those discussions, and stop trying to, put the rose-colored glasses on and just pretend that everything is just amazing and is going to always go to plan. Because once again, as being in the business a long time, we have been on a tremendous bull run that's just unprecedented. But and that's great. It's great for a lot of people, made a lot of money doing it, but it doesn't mean that even in the midst of those bull runs that you should get sloppy and reckless and just sort of, not pay attention to what's going on, because you never know when something's going to sort of turn.
Yeah, eventually the music's going to stop, and we don't know what that looks like. Maybe it's a screeching halt and things break like they did in 2008, or maybe it's just a little bump in the road. We don't know exactly what that's going to look like, but you got to be prepared for it, and you have to understand, how that could happen, and how do we mitigate our risk so that we're not losing all our investors' capital. We're not, there's a lot to be thinking about when you're thinking about that. And we're on a long bull run. It's great, but eventually it stops. Eventually the music stops. Real estate always goes up, but there's balance.
It's always, I mean, that's where the opportunity is. That's what I mean. It's just that it's investing. And I think that, of course, for those of us in the business, it's a lot easier because of the lack of volatility. There's a lot less stress involved than it is being in the public markets, where you're exposed to just a tremendous amount of variables and volatility. That's tough. And so, but it doesn't mean that, once again, in real estate, it's low volatility and it's uncorrelated, and that's what makes it great. But it's still, like I said, you got to be really thoughtful. There's still the risk. You never know. And even when you're, you just really never know. And I think that the great investors want to stick to the fundamentals, right? They have conviction. And that's how they make decisions. And that means sometimes a lot of guys will sit on the sideline, and some guys won't, and they'll stay in the game and they'll still make a bunch of money. But as an investor, being able to identify sort of who's in which camp, and then deciding, once again, where's your own risk aversion, right? Because for me, I'm an entrepreneur. So of course I'm willing to, I'm not risk averse. I mean, it doesn't mean I'm reckless, but it just means that I get my mind wrapped around where the risk is, and I can make a calculated decision. And, and especially given the portfolio and how much you allocate to that, that's what makes a great investor. Sometimes you make big bets, but you're not going all in on any one thing.
Yep. 100%. Man, I could keep talking to you for a while. This is a fun topic for me to talk about, but for sake of time and for my listeners, we probably should wrap up here. A couple last questions that I like to ask every guest on the show is, what's a favorite book that you can recommend to our listeners?
Yeah, so if it's on the bookshelf back here, I think it's right there. Influenced by Robert Cialdini. Is my favorite book. So I read it once a year, and it's all about the psychology of how us as humans make decisions, and how we can be manipulated, but also for good, right? To move people through change. So highly recommend, reading it, no matter who you are. That's
a first time anybody's ever recommended that book. So that's awesome. I appreciate you.
Yeah.
I love hearing new books.
It's a great book. It's been around forever. He's revised it several times, but it's foundational and fundamental. And if you want to, be a more successful human to navigate through this world, I think you'll be better off after you read it.
That's awesome. Lance, what are your 3 pillars of wealth creation? 3 pillars of wealth creation.
Yeah. I mean, I think number one is just, it's patience. Right. So it's long game. Wake up every day and just keep moving. Right. 2, discipline. same thing. It's not getting overly excited, right? Just try to do the best you can do to remove emotion from these situations and be as analytical as you can, given what you've got, right? And I guess 3 is just, you've passion or interest, right? Like the curiosity that comes with it. So I have no interest in sort of oil and gas, right? It's just not interesting to me, right? Like, and there's certain other things that it's just, when you're going to invest, once again, it's your wealth. You sort of have to figure out like what lines up with what interests you, right? Because it does require this curiosity where you want to kind of dig into it. Some guys like all this sort of crypto stuff or whatever. I mean, I'm not against any of those things. To the degree that you do your homework and you have interest and you can dig deep enough to where you get comfortable, then you do it. But if you're not there and it's feeling forced, then you shouldn't. It goes back to the Warren Buffett thing. It's just, you got to invest in things you understand.
Yeah.
If it doesn't make sense to you, you have no business, investing money in it. That's speculation, and you're more than likely going to get burned. So that's how I kind of look at it.
I like it. Somebody asked me the other day why aren't you investing in crypto? And I said, look, because I have no clue what I'm doing. I don't know anything about it. And I know everything about real estate. And so I'm going to stick with what I'm good at and what I know. Well, that's it. Like, I could maybe make a lot more money with crypto. Maybe, I don't know. Maybe my dollar would turn into, millions of dollars, but I have no clue. I don't really know. And quite frankly, I have no interest. And so I'm not gonna do it. It's funny you mentioned. I kind of laugh when you said that your 3 pillars: patience, discipline, passion / interest. I was just talking with one of my coaching clients yesterday, and he's talking about all these other people around that are posting on social media and they're buying all these properties, and he's not posting all his properties. He's only bought a couple. And I said, well, look, first of all, you can't compare yourself to others. Like, you've got to have patience, right? You've got to have patience. We're in this crazy market right now. You have to have patience and discipline in this market and understand where you're going and not worry about all these other people. And then we talked about his interests, and he's talking about, well, should I be raising money? Should I be looking for deals? Should I be doing this? Should I be doing that? And I said, well, you got to figure out what your interest and what your passion is and what you're going to be good at, because so it's just funny that you mentioned those 3 things, because that's exactly what we talked about, is those 3 things and how he's going to be successful. So I really like your 3 pillars. Love the book recommendation. So I appreciate that. And just really enjoyed talking about, your company, verifest, really what you guys do. And I really am a firm believer in what you're doing. I think it's a great service. Hopefully it's a great profit maker for you now and into the future. But at the same time, it's a great service for real estate investors, passive ones, and the real estate companies that are looking for those passive investors. I think they marry up pretty well for each other.
Yeah. Thanks, Todd. Yeah. I appreciate you having me on. It's always good chatting, and yeah, it's good stuff. Yeah. Like talking about this stuff.
Absolutely, man. Well, Lance, again, really appreciate you joining us. Really appreciate your time. And I know my listeners have learned a bunch from this episode. So again, appreciate it. And you have a fantastic rest of the day.
You too, Todd. Take care, man.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. But your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.